Welcome everybody. This is our first monthly client video. We're starting to do something a little different here at Ellsworth Advisors. I want to welcome everybody for joining us. Today is February 13th, 2019. I'm Kelly Kuennen, and joining us is Cameron Miele. Anyone who was on our last call, which was back in December, that's when we introduced Cameron. Maybe another introduction is in order. Cameron has joined us from Colleague Capital. He's been part of the Ellsworth team really for the last probably 6 months or so. And he's helping really in business development, and also really serves a role in really dealing with our business owner clients, helping clients maximize business ownership or business valuations for our business owner clients, and also just run general financial advising. So as was typical with our client conference calls, I'm going to start off, talk a little bit about the markets, what's happened since our last call, which once again was on December 13th, and then also talk a little bit about how our portfolios have performed over that period of time. Cameron, you want to add anything for the introduction?
No, other than look forward to speaking with all of our clients and getting to know them.
So as usual, kind of talk about what's happened since the 13th of December and a little bit on 2018 in general. 2018, from a stock market standpoint, and for really across the board for financial assets, was a pretty challenging year. Looking back, the only thing that really made money last year were short-term government bonds. High-grade corporate bonds did not do that great, actually lost a little bit of ground. Longer-term treasury bonds actually lost a little bit of ground. So cash and short-term treasuries, that's the only place that had positive returns. The stock market in general, the S&P for 2018 was down 6.24%, so a pretty rough year for the stock market. But just that end number truly doesn't tell the whole story. Started off the year with a big rally in January. We had a pretty substantial 10+% pullback in January. Then the market regained ground and things were looking pretty good going into the fall. With a strong September, in October things started. We saw a peak in the market in September where the S&P, which is currently around 2740, peaked out around 2930. So it looked like we were almost going to hit 3,000 on the S&P before the end of the year. But October things started getting a little more dicey. November, not a strong month, and then in December, really we had an 18% pullback in December. So the market almost retreated 20% in December, where 18.7% from the high in December, which was around December 3rd, hitting a low in December on December 24th. So that pullback was about 18%. At the end of the year, end of December, we had a little bit of rally. Since that pullback, really from the low point through Monday, we actually saw the S&P regain about 15.3%. So from going down 18.7, recovering 15.3, like I said, that was through Monday. Yesterday was a pretty good day in the market, so that actually closed the gap by another percent or so. So we're almost back to the highs that we saw in December, or the December highs. Still, 4 or 5% from the September highs, which was the all-time high. Currently, the outlook looks in the short term. We wouldn't be surprised if we retest those highs and exceed them in the short term. So that's the U.S. market from our last call. So back on December 13th, just in the short term, from December 13th till now, we're up about the S&P is up about 2.2%. The international market's up about 1.8%. So what we see happening is U.S. is still leading the world. A lot of challenges in the international space, specifically Europe, Japan, and even the emerging markets are being challenged too right now. Year to date, so from the beginning of the year till now, S&P is up about 8.1%. Like I said, that was through Monday. Tech on another 1.5% or so, including yesterday, Tuesday, which was a pretty strong day in the market. International stocks year to date are only up about 5%. One position we've added into a lot of clients' portfolios just over the last several weeks. Out of concern for the volatility, we have added gold into the growth with income portfolio. Year to date, that's up about 2.2%, which from the time I added until now, we've participated in some gains there. When we look at our various portfolios, and really what I'm looking at is, are these portfolios performing in line with what they should be doing, compared to the market, compared to the stock market, the bond market, emerging markets, and so forth. And the growth with income portfolio, which is really our more balanced portfolio that's in most of our clients' accounts. Since our last call, right now, growth with income, going into the end of the year, we're about 65% stocks. Over the last several weeks, I've started rebalancing that portfolio. We're taking a little more conservative stance, reducing some of our risk exposure there. And since our last call, it's up about 1.8%, and we're down to about 55% stocks. Year to date, growth with income is up about 5.27. Once again, these numbers are through Monday. In comparison, how did it handle the big downturn in December when the market pulled back 18.7%? Growth with income, had about half of that volatility. It was down about 8.8%. From the low point until now, from a recovery standpoint, growth with income's bounced back about 7.3%. Once again, this is through Monday. After yesterday, it's closed the gap, so we're almost back to where we were back on December 3rd. Price potential, which is one of our all stock portfolios, really geared around growth and short-term 12-month out growth appreciation. From our last call, about 2.7%, so a little bit stronger than the market itself. Year to date, about 7.55%, lagging the S&P slightly. From peak to trough, market dropped 18.7. This portfolio went down about 13.7%. So, not quite, about 5% less than what the market itself did. And from the low to the high, it's recovered about 11.38%. So once again, not as much on the downside, not as much the upside. So it's a little bit less volatility through this last period we've seen. Our dividend yield portfolio, since our last call, this is all basically 20 stocks with above average dividend yield, real high quality balance sheets, above average dividend yield. So since our last call, up about 3%. So that's actually, since middle of December, that's performed pretty well relative to the markets. Year to date, though, only up about 5.97. So we've seen a little bit more appetite for risk since the beginning of the year. And typically, this portfolio is not going to participate as much on the upside. From a downside standpoint, from the peak to trough in December, only down 10.8% versus the market was down 18.7%. From the low in December till now, up 7.96%. So actually, from the lows till now, it's performed pretty well. And once again, we're seeing a little bit more movement towards quality, more value orientation, which is kind of what this portfolio provides. Last portfolio, our small cap portfolio, since last call, up about 2.15%. Year to date, 7.43%. Peak to trough, this is small cap stock, so inherently more volatile. This went down 14.3%. Once again, not as much as the market itself. From the low to the high, or from the low point until now, we're up about 13.37%. So good bounce back. A little bit less than the market itself, but once again, kind of a different market, being small cap stocks versus the S&P, which is mostly large stocks. So in general, the way the portfolio's performed, we really, over the last 18 months, have cleaned up quality, and I think that served us well in the heightened volatility of December. And from a rebound standpoint, typically when you have less downside, you're going to have less upside. But going through that volatility really kind of confirmed that being a little more quality oriented, I think, is where we want to be, especially moving forward. in the context of the economy, which I'm going to let Cameron talk a little bit about, kind of what's been going on. A lot of the talk in the press has been about, do we have a recession coming? A lot of fear out there that, hey, things are going to collapse, earnings are going to, go down to zero. And kind of early numbers on what happened fourth quarter. Fourth quarter GDP, the preliminary estimates are between 2.5, 2.7%. So still seeing growth in the economy in fourth quarter. And earnings, there's a big question mark. How strong are earnings going to be last quarter? And at this point, earnings are coming in around, growth of about 15.6%. So, and that's with about 70% of companies reporting as of last week. So we're still seeing decent earnings growth, year over year numbers. So that gives us some encouragement that, if there's a recession coming, it didn't start fourth quarter last year, which if we were sitting here talking a year ago, there were some pretty bearish commentators out there, bearish economists, strategists that were thinking that, hey, recession was going to start in 2019. 2.5% growth in fourth quarter. It did not start in 19. Now the question is what's going to be happening moving forward. Cameron, I know you want to make some comments on what you've been hearing and kind of thoughts or questions that have been coming up from clients.
Sure. We've really, Kelly, over the last couple of weeks, a couple of questions, consistent themes that have come in from our clients are, is the volatility here or is it going away? What is going to happen with interest rates? And are we on the doorstep of a recession? They kind of all really work together. In December, I think there was a lot of fear about the China trade situation, about corporate earnings, about a pending recession. So that led to a lot of volatility. We've seen the volatility kind of smooth out now as corporate earnings have come in and have been pretty stable, been pretty strong to the upside. So our expectation right now is that the volatility will moderate. We're still going to see ups in the markets. We're still going to see downs in the markets. That's why our portfolios are high quality companies, but we do expect that volatility to moderate slightly. On the interest rate front, 6 months ago, the consensus was that there'd be 100 basis points of interest rate increases in 2019, approximately 4 25 basis point increases. If you look today at what the Fed has been saying, the Fed has really softened their stance, and they're going to take the interest rate environment on a case-by-case basis. So I think at most we're looking at a 50 basis point interest rate increase, maybe even a 25 basis point increase in 2019. So definitely the expectation for rising rates has come down. I think the biggest issue that everybody's talking about is we have been in an expansion now since 2009. Call it approximately 10 years. When is the ride going to end? And interestingly enough, did a little bit of research, and if you look at the global market, Australia, for example, Australia has been in a 25-year expansion. So just because we assume that an expansion has to end doesn't mean that it necessarily has to end. There are 4 major buckets that we research when looking at the global economy and the fear of a recession. Those indicators broadly are business activity, consumer, inflation, and financial. Financial, we're looking at the yield curve, at credit spreads, at the money supply. Inflation, we're looking at wage growth and inflation in commodities. With the consumer, we're looking at housing permits, jobless claims, retail sales, and job sentiment. And on business activity, we're looking at new orders, profit margin, and overall shipments. And I can tell you currently, as compared to the last 7 recessions, the latest or the earliest one was the 1960 to 1970 recession. The last one was obviously 2007 to 2009. And right now, of those 12 indicators, we've got a couple yield curve and credit spreads that are in a caution state, but the other 10 indicators all foreshadow a continued expansion. So I think today, our sentiment is that we're closer to a recession than we are to continued expansion. But the variables that we use to foretell coming recessions, and this is a 12 to 18 month outlook, they're just not there right now. And so the world economy is definitely slowing down. Kelly hinted to it. Europe, we're seeing some disruptions, we're seeing some slowdown. We've got some credit issues, we've got Brexit. In Asia, we're seeing some slowdown. This trade battle with China has definitely hurt. We're China's #1 trade partner, and they're feeling a pinch, so we've seen a slowdown in the Chinese economy. The U.S. economy has slowed, but profits are still growing. As Kelly said, corporate profits are growing 15%. So the U.S. economy, interest rates remain low. The consumer remains very excited and very optimistic. Wages are rising. Corporate profits are rising. They're not rising as fast, but they're still rising. So, really, we don't see anything right now that tells us we're entering a recession. I think the one thing we're both cautious about is the U.S. does have an addiction to debt, and long-term, that addiction to debt, will be problematic. We'd like to see Washington rein in their spending, but right now the U.S. economy really does look to be the world leader, looks to be very strong, and so we remain bullish, but are obviously always going to be cautious. There are events out there that happen, credit crisis, terrorist events, China trade battle. Any one of those things could put the global economy into a tailspin. But right now, we really don't see any strong indications of risk. So we're going to continue to buy high quality companies, continue to actively manage our portfolios, continue to protect our clients from the downside and look to the upside. But right now, I feel very good about where things are at, and we're excited to see how 2019 rolls out.
I'd like to add a few comments on some of the things Cameron talked about. One, we don't think the recession's going to happen in the short term, but the reality is there are signs in our economy itself that are definitely things that play out late in expansion, such as the strong employment numbers. Fantastic number last week. I think 305,000 jobs created, which was well above consensus. But you get your strongest employment at the latest stages of an economic cycle, and so that concerns us. So we want to stay invested. We're not looking to pull our horns in completely, but once again, we need to stay. We need to stay in equities for the growth component of it, because interest rates are on the lower end. They're higher than they were. We can make money in short-term, high-quality government bonds or high-quality corporate bonds. But the reality is any kind of cracks in the economy, we want to avoid what's going to be really challenges to the credit markets, meaning your lower quality bonds and so forth. They've recovered a lot from their lows, but we still see risk there. And we just don't want to be in those areas that expose us to too much risk than what we have to take. And especially late in a cycle, we need to get the returns we can from the equity market. Once again, sticking with quality. And you're starting to see a little bit of a shift. And I think that's why you see some outperformance in some of our all stock funds, whether it's the price potential or dividend yield, because we're more selective. We're not buying the whole market. Your better quality companies, your more sustainable balance sheets, companies that can handle their debt, they participate in the upside. And through this earnings period, you're seeing a dichotomy where if a company comes in with good earnings, they're being rewarded in stock price, but a company in the same sector can see their stock price beat down if they're missing earnings. A great example, in our growth of income portfolio, we were holding two different more chip-oriented companies, whether it's Microchip, which since beginning of the year is up 23%, versus Qualcomm, another chip company, which is down 12%. Same sector. If we were sitting here 12, 18 months ago, and if one chip company reported good earnings, they all would have went up. Now we're seeing that dichotomy, which is good for the way we've been really choosing our stocks, more recently, last 18, 24 months. So I think we're positioned well for it. I alluded to some changes we made in the growth of income portfolio. One of the big themes that I'm really looking at with client portfolios is going to a little more simplistic approach, meaning equities, high quality, not going out too far from a risk standpoint, and then even on the bond side, really skinning up to what we want to hold is shorter term treasuries. Yeah, we're going to make a little bit of money, but the downside risk is minimal, if at all. Really no risk there, to kind of fill the gap between equities and the treasuries. We did buy some gold positions. We did a position GLD, which is a gold ETF. That's kind of our risk insurance. If things really start to get dicey around the world, if there's any kind of crisis, gold will participate in that. We still have a little bit of broad-based commodity exposure, where broad-based commodities. Now, commodities definitely hurt us last year because of the strong dollar. If the dollar continues strengthen, that's going to challenge commodities, but we have them in there as more of a defensive insurance type position. And the reality is, if things keep on going along strong, gold commodities aren't going to do a whole lot for us, but we've eliminated some things that could be a drag on the portfolio. So that's really what we're looking for. So far this year, the numbers look good, but we're only halfway through February, and we have to expect some bumps along the road. And I think one of the biggest challenges is going to be what's happening in the world, whether it's Europe or China. And the question mark is, will their slowing down drag down the U.S. economy? I think is really what it's all about. I think some of the risk from the Fed getting too aggressive on interest rates, that was kind of taken off the table, where Chairman Powell basically said, hey, we're going to watch and see before we get any more aggressive on raising interest rates. The challenge the Fed has is the rest of the world still has really low interest rates, and even though the Fed's raising rates on the short end, if we still have the most attractive rates in the world, that's going to cause dollars to buy our bonds, which will inherently keep our interest rates down, which could force an inverted yield curve, which is not a good thing. That hurts lending. And in the past, a lot of people hypothesize that that's really what's caused some recessions. And I think the Fed now is in a position where they don't want to cause the next recession, so they have to be careful on what they're trying to do. So that's kind of the outlook and how we're putting the portfolios into that context.
Yeah, the Fed is definitely in a tough position, but that's their job, to manage the monetary supply, and they've done a pretty darn good job of it so far.
So I think that really covers what's been going on. We addressed some of the stuff that we're hearing headline-wise, what you see on CNBC, questions clients that are that have been asking us. The reality is that our clients really held on through the downturn in December. December things look really ugly. Even though portfolios are down, accounts were down, not as much as the market, but even though if you're down 10% at the height of the pullback, 10% is 10%. Even though the market's down 20, we're still down 10. And we had a lot of nervous calls. People were patient, and the fact that clients were patient, we've been able to participate back in the upside. And like I said, we're almost back to where we were at the highs in December. Not to the highs in September, but I wouldn't be surprised if we get back there in a relatively short period of time or over the next several months. We don't want to get there too quickly, because that could cause some overheating, but we have to expect there's some more volatility ahead of us. But the key is if we're patient, there's nothing big out there screaming saying we have to get too conservative. We've made those adjustments, and now it's really a matter of looking at each individual client's situation differently, making sure we have adequate cash on hand, or liquid assets, or short-term bonds where we can move money in and out without any kind of market risk. And that's really where we've put people at this point in time. So I feel pretty good, at least for the next 3 to 6 months. So that's going to pretty much wrap up our first video here. A little different than doing it over the phone. For me, it's odd. I'm used to being able to just talk through it. With cameras in front of us, we'll continue to refine this. But this is going to be our format moving forward. It's not live, so we can't ask for questions from the audience. But as always, if you have questions or want to talk about your accounts, shoot us an email, give us a call. We're always available for you to address your questions. And obviously, put in the context of each individual client's accounts is different than talking broad-based, because not everybody's allocated the same. Most clients are in the same type of portfolios, or the same portfolios, but in different mixes and matches. So, what we're talking about today is impacting almost everybody, but to different degrees. So we're going to leave it at that. Thank you once again for watching this video, and please reach out to us if you have any questions or comments, or you want to discuss things in more depth. Cameron, anything to close it with?
No, other than thank you to everybody. Look forward to working with all of our valued clients. You are our number one asset, and we are here to serve you. So at any time you have questions, email, cell phone, please get in touch with us. We're happy to get on the phone and just walk through our continued thoughts on the economy, on your investment accounts, and where we see things going. So thank you very much, and look forward to doing this again in a month.
Have a great day, and enjoy your Valentine's Day. Thank you.